All right, I'm Michael Hartzman. Today is Tuesday, June 10th, 2025, and I'm on as always with my partner, Dominic Tavella. Good evening, Dom. How are you?
Doing great, Mike. Right back here in New York with you. So a little bit of a temperature difference from today to my last spot. So back in New York.
I understand. Well, when you left, it was raining. When you came back, it was raining, and it hasn't really stopped raining ever since. So you didn't miss much, I'll tell you that.
I don't know. Other than it was a lot warmer where I was, I don't know that weather-wise we missed anything. But my gosh, Mike, can we switch quickly to what these markets have been doing? Been quite surprising.
So with the Trump administration labeled as Liberation Day, which I love that expression, that was this quarter, right? That was April 7th or 8th, I believe. And the market, to put it lightly, got clobbered. And the S&P at one point this quarter was down 20, almost 20%. The so far through Friday, the S&P is up 7.2%. We've seen volatile markets in the past, Dom, but to say that this market has gotten whipsawed is an understatement. And while I am happy, I got to tell you, this just makes me really a little nervous to say the least.
Uh, I'm sure we're going to get into a deep dive of that, right, Mike? But to your point, I think April 8th may have been the bottom. So let's say the 8th and 9th of April, where we're talking about the S&P and the NASDAQ were down 18-20%, right? And that was just the complete reaction of markets and what they expectations were and announced by the Trump administration regarding tariffs. And now here we sit. And I think year to date, the S&P went from being down at that 18% today. Friday, excuse me, closed Friday, we were up 2.6
Yep,
for year to date.
yep.
So talk about a full turnaround before you could blink. If you had panicked and sold out in April, you literally would be sitting with 20% less money in your pocket. If we just compare it to the S&P 500. So my goodness, we talk about headline risk all the time, Mike. That was a complete headline scary moment, and the markets now are shrugging it off like nothing happened. It's
Yeah, and
amazing to me.
like and as you said on our show last week, it was just me and you. Um, if you went to sleep on January 1st and woke up and you saw year to date the S&P is up 2.6 and the Nasdaq is up 1.4 year to date, you'd be like, huh, I guess nothing's happening. Why is the
Yeah,
market so sleepy?
boring year, right, Mike? Yeah, nothing happened. And my goodness, something happened. And we're going to spend a lot of time talking about a great guest this evening. But my goodness, does anybody think this is over? Does anybody out there think the volatility is over? Can we really sit here, Mike, after having gone through what we just went through and go, oh, it's all good? Yeah, the rest of the year it'll be quiet and peaceful. What do you think, Mike?
Well, obviously, I agree with you, and that's kind of what makes me nervous, Dominic, because other than snippets of good news about these tariffs, and other than, all right, Trump is going to back off here and there, we're more than 90 days past, I'm sorry, we're more than, I think, halfway through his deadline, or just about halfway through of this 90-day window. But it really, nothing's changed other than maybe the rhetoric is not as overheated, Dom. What has really changed to have the market literally do a 180?
Um, so at the risk of you laughing out loud, Mike, I'm going to go. We have a little bit more clarity. And I'm particularly going to focus on where we are in the economy. So it does. We got a good jobs number on Friday. We've spoken about that. Basic economic news has been relatively speaking healthy. I won't say spectacular, but healthy. Corporate earnings, on the most part, have been more positive than negative, even though their own projections had been lowered, expectations had been lowered, they're more systematically beating those lower expectations. So simplistically, the economy doesn't look like it's gonna fall off a cliff and go into a recession. And that's a big part, I think, of the recovery. And throw in that maybe we're seeing some softening in the stance on tariffs, that maybe the tariffs themselves will be a little bit more reasonable than were originally announced. So I think this is a big sigh of relief, but I think we both agree we're a long way off from being done with volatility.
Yeah, look, and I've said it before, and I don't think we're really going to know we're in the clear in the short run until we get the second quarter's data. You know, the CPI, the inflation numbers, because we don't know still, the wreckage that was caused in the first part of this quarter, and until we know one way or the other, then with the Federal Reserve will have some clarity. But I do agree with you. We got some good jobs numbers. Inflation is drifting down. And as always, I have my JP Morgan weekly market recap cheat sheet. And I don't know if they coined this phrase from the jobs report, and we'll ask our guest, but the way they looked at the jobs numbers which were fairly positive on Friday, was they called it no hire, no fire. The job market strength includes companies approach due to recent labor market tightness. So I guess that's a double-edged sword, right? We don't have mass layoffs, but we don't really have much expansion going on. So what do you make of that?
And I'm going to say you're on the same page with me on this one, Mike. But pretty much what we've been hearing from our own clients that own businesses, right? Hey, literally, I've heard we have a hiring freeze. We don't know what the tariff situation is going to be. So no new hires. Then you go, oh, you're laying people off? Like, oh, not really, because once I lay somebody off, number one, these employees have become part of our family, right? So you just don't indiscriminately lightly fire somebody. And the second point is you fire somebody, good luck hiring them or somebody else new in the next month or 3 or 6, because hiring is quite difficult. So people, small businesses particularly, are really holding tight to their existing employees. But there's definitely a hiring freeze now. I don't think we're breaking any news here. There's definitely a hiring freeze going on.
Yeah, and I did talk to a client yesterday who was furloughed, and really, I think that's an employment technique you don't hear much about. But so what that meant to him is they're not paying him anymore, but they're providing him his benefits, right? So maybe that's another trend that is beginning to happen. But I agree with you. Some of the unknown is beginning to trickle through the economy. And as I said, we don't know the short and long term effects of that yet. And especially when we don't know when we're going to get solid deals actually announced. It's just been snippets of an idea that we've been getting, leaked out here and there.
Yeah, and Mike, you can look at this as both good news or bad news, but once we get real clarity, then these businesses, and again, we're focusing primarily on small business, and we've had guests on our show that really had expertise in this area. But these small businesses, for the most part, are going to be very quick to react. So if the news is relatively good with the outcome of the tariffs and economic growth, then they'll be in a position to make a decision. They're not going to be 43 layers of administration they got to get approval from, right? They'll be very quick to react to hire. Flip side of that is if it's bad news, they're going to be very quick to, hey, and we've already seen this, hey, pay cuts to middle management and capital expenditures being really brought in. So these businesses can be very quick to react, both positive or negative, and we're going to see real economic effect relatively quickly.
Yeah, and the other part of that, Don, which we don't really talk about much, and we're going to ask Mira, our guest tonight, is inventories, right? Because a lot of companies who buy things overseas have really they didn't put a stop to it, but they're much more careful with their purchasing, is what I've been hearing.
Well, and this is a great question to bring up, Mira. Dan Niles, a very famous hedge fund manager, brought up imports increased by over 40% in the first quarter of this year. So companies being smart, hey, we know these tariffs are going to come in. Let's just really front end load these imports, bring them into our factories, bring them into our warehouses, and then we'll have some inventory we can live off of while we figure out what goes on with the tariff. You got to believe all that pre-ordering, pre-hedging this potential tariff coming down the pike here. It's going to have some effects in the second half of the year, Mike. These companies are not going to double and triple order, especially if there's a tariff on top of it, right? So you got to
Exactly.
figure there might be some global growth implications on this because the ordering for inventory may not be there.
Yeah. Well, this is enough of you and I yapping. Let's get to the brains of the outfit.
Yeah, let's get
Um,
to the smart people in the room.
so tonight's guest is Mira Pandit. She's at JP Morgan, who's been wonderful to us and always gets us guests. She's an executive director and global market strategist. She works with Dr. David Kelly. Was one of our original guests when we started this show 3, 4 years ago. She's been unbelievably successful since then in her career. And we are grateful that she made the time tonight to rejoin us on our little podcast. So we will be right back with Mira Pandit, Executive Director at JP Morgan Asset Management. All right, I'm Michael Hartzman, back with my partner Dominic Tavella and our guest this evening, Mira Pandit, Executive Director at JP Morgan Asset Management and one of their global market strategists. And dare I say, financial TV famous since we saw you last. Whenever I look up at my TV, there you are.
Well, thank you so much for having me. I'm excited to be here and yes, do a couple of rounds of the financial news circuit, but I really love sharing our outlook and our views on the markets and the economy because so much is going on right now and I think there's also a lot of noise, so we always try to simplify the complex, see the present with clarity and try to cut through some of the really scary headlines.
So, number one, congratulations on your success. It's well deserved.
Thank you so
And
much.
you're welcome. And let's just get to it. You were listening to our open. I don't know if I've ever been, this cloudy on why the market is doing what it's doing right now. Is there any logic to what you're seeing in the last few weeks?
I think what you had mentioned up front is the perfect encapsulation of how so many people that we're talking to feel. Hey, I'm glad to see the market up. I'm glad to see that my portfolio has recovered, but I don't know where we go from here. And so, one of the other angles we've been looking at in terms of trying to answer this question is not necessarily what is driving the rally, but who. And we have our counterparts in the investment bank have done some really fantastic quantitative research on retail flows, who's buying, and they've found really inventive and creative and very impressive ways of trying to calculate how much is the retail investor buying. And they found that April and March were actually back to back two of the strongest months that they've seen for retail buying. So, one, you definitely had investors buying the dip. That's come down a little bit in strength over the course of the month of May, but nonetheless, you still had a lot of retail activity. And the other thing that we've seen is corporate buybacks. So, in the midst of company prices coming down, companies have come back in to buy back their stock and repurchase shares. Now, some of that could be the fact that companies are fundamentally in a pretty good position. But if they are feeling uncertain and worried about policy, maybe they don't want to make that CapEx decision, or as you all mentioned, the hiring decision either, but they can make a pretty simple capital decision to just repurchase their shares. So some of the who's buying, I think, certainly plays into the conversation as well.
So Mira, we met with you guys. You were very cordial to invite us into Manhattan, and we met in your offices and talked to all the really, really smart people, and what your expectations were. And I think, Mike, correct me if I'm wrong, but it was very early in the year. So I guess the loaded question is, how has your thinking changed much in the last 4, 5 months? And what are you focused now relative to what we were looking at maybe 4 or 5 months ago?
It feels like the question is, how many times has your thinking changed
Well,
in the
I'm
last
trying to be polite.
four
I
or
know we,
five
in the middle of
months?
the show, we might get a tweet and then
Yeah.
all things will change again. But yeah,
And
that's a great point.
that happened to me. That happened to me on April 9th in the middle of a presentation. Someone said kind of in the chat box for the Q&A, hey, did you see that these tariffs have been postponed? So sorry for wasting everyone's time. We have to go back to the drawing board a little bit here. And it's felt like we've had so many different recalibration moments over the course of this year. And I think where we are right now is leaning into how we were feeling about the overall economy and markets coming into this year, which was we've had a number of years of really strong economic growth. We're probably going to see some sort of slowdown. Maybe with some of the uncertainty, this heightens that slowdown and perhaps makes it a bit slower than we would have thought even coming into the year. But we think we can still avoid recession this year. Look, the uncertainty certainly does play into how consumers and businesses choose to spend. Businesses often consider slowing their purchases, but business spending is about 13% of the economy, whereas the consumer is almost 70% of the economy. And what we have seen in the past is that sometimes consumers feel pretty rotten, but they spend through the pain. And they've also gotten some degree of relief on things like gas prices. So it is possible that the consumer continues to hold us afloat. And you talked a little bit about hiring up front. Although it doesn't feel like there's going to be a lot of additional job growth, people broadly do have jobs right now. So if people can just hold on to them, that continues to power their spending. So overall, I would say we went from we think the economy is going to slow to April 2nd announcements, we're perhaps headed for a pretty severe recession to mild recession. And now we've kind of gotten back to the point of much slower growth overall this year.
So to that point, I have tremendous respect for your boss, Jamie Dimon. Dom and I have had the opportunity to meet him as well. He strikes me over the last several years that he just says what's on his mind, and good for him, right? Because sometimes these corporate titans, they kind of try to couch everything they say, and he seems to be the canary in the coal mine, where he just came out and said, you know what, we're gonna have 60% chance of having a recession as a result of these tariffs. Has he kind of calibrated that more recently, or is he still a little more negative than most, Mira?
I would say that he's certainly been very assertive in highlighting a lot of their risks over the last couple of years, not just in
Hmm.
terms of recession risks and policy risks this year, but also around interest rates over the last couple of years. And I think what we also have to remember is I don't want to speak for him here, but he's coming from the position of somebody who oversees a huge balance sheet. And we have seen in times of duress that that balance sheet has been really important. And therefore, he has to consider the overall position of that balance sheet. I think as investors, we're coming from a slightly different purview where if we are overly cautious from an investment perspective, we risk not growing our portfolios enough to meet our long-term objectives. And we have seen this on the ground with clients time and time again, where they get a little bit spooked by what's going on, and there's always something going on. They want to sit in cash for a while. They want to keep that larger cash allocation. And again, we've seen it for any number of reasons, what the Fed's doing, what's going on with the election, what's going on with tariffs. So what we've then seen in markets through many of those environments is that markets have been pretty resilient. Think about the 100% recession odds in 2023, and we had a 20 plus return that year. Think about last year, everyone's so worried about the election. I'm going to bail on the market if this person wins. I'm going to bail on the market if this other person wins. And yet again, we had another 20+% year. All of that in an environment where we had over 4% policy rates for the first time in 15 years. So I do think it's also important that investors not only consider the downside risks, but the upside risks and make sure they are exposed enough to the market to capitalize on some of the upside that we often see, more often than not.
Well, and maybe coming back to the comments you both made, I think Jamie's literally pointing out that there are storm clouds out there, right? To be ignorant or just close your eyes and make believe that they don't exist, I think is foolish. So to that point, what are you guys seeing as the storm clouds? What are you kind of looking at the horizon, going, maybe need to keep an eye on that. Maybe we need to worry a little bit about that.
It feels like anytime we reach one of these points in the market where it seems kind of calm and markets are rallying, we're all kind of holding our breath for the next thing. So I think that the collective sentiment is that we're not out of the woods yet. So a couple of things that we're keeping tabs on. One is we do think the consumer can be resilient this year, but that is going to be a question mark. We have to continue to monitor if there are any cracks in the consumer when it comes to the economy, because that could make or break the economy this year. Right now, we think probably makes the economy rather than breaks, but nonetheless something to keep an eye on. We certainly want to keep an eye on valuations within the equity market. They are right back to where they started the year. So in an environment where things are expensive, we often think, look, if something is priced to perfection, it is primed for correction. And anything, the wind blowing can unseat those valuations. So we want to be mindful of that. We want to be mindful of how realistic are earnings expectations this year. Looking like 9+% growth on the S&P 500 seems a little unrealistic in the environment of slower growth overall. Now, let's also think about some of the more existential issues, the debt and deficit. It looks like we're going to continue to see our deficit climb. Our interest payments are essentially $1 trillion right now every year. So these issues have started to seep into the markets themselves, particularly when we look at things like treasury yields, where there are a host of upward risks to yields around, who's going to be the next big buyer, given that the Fed is no longer the big buyer in the market. You have more price sensitive buyers. The political uncertainty has certainly fed into some of those higher rates as well. We have to think about, again, the debt and deficit concerns and how much investors want to be compensated for holding government debt that is essentially underpinned by finances that are pretty unsustainable or unbalanced. So a number of risks there around valuations, around rising yields, around debt and deficits, and how realistic the prospects are for earnings and consumers.
Mira, in addition to, what JP Morgan tells us and what you and Dr. Kelly tell us, Dom and I, listen to Dr. Siegel from Wisdom Tree and we listen to the folks at BlackRock. And a couple of weeks ago, Dom and I heard two interviews back to back, one day after the other, where Dr. Siegel is pounding the table for interest rate cuts now. And Rick Reeder is saying Jerome Powell needs kind of to stay steady and it's not appropriate to lower interest rates now. Where does your team land in terms, their opinions aside, where does your team land in terms of the interest rate story?
Right now, if we do avoid recession, there's not a whole lot of reason for the Fed to cut yet. And remember again that rates have been high for a couple of years now. So I think the long and variable lags conversation is long behind us. We have seen that this economy can withstand a higher level of rates pretty successfully. What we want to make sure is that inflation is stamped out once and for all, and it has stabilized at a low level close to the Fed's 2% mandate. Doesn't need to be all the way down to 2.0. And certainly you probably want to start to lower rates a little bit before we get to that point so you don't overshoot. But what's likely to happen over the course of this summer is we're going to start to see tariff impacts to inflation. And so you could see that inflation starts to pick up, which means optically it would be very hard for the Fed to cut rates if inflation looks like it's accelerating, while growth is maybe not decelerating that quickly. So they're very much in wait and see mode. And I think that makes sense until we can see not only what the policies are, but then what the impacts from them are. And it's likely that the inflation bump we see from tariffs is a one-time pass-through. Now, I know that raises some flags for people because they think about the word transitory and how that was used a couple of years ago and it didn't really feel like transitory. But there's a couple of different things today relative to that environment. One, you had a big spike in commodity prices because of the war between Russia and Ukraine. Two, you had lingering supply chain issues, which pushed up goods prices. And three, you had a mountain of excess savings from consumers. So they were pouring that into goods, services, anything they could get their hands on. And that was also when we were seeing some of that shelter inflation pick up as well. So we're not necessarily seeing any of those factors today. So we do think that this could hopefully be a more of a contained episode of higher inflation. That being said, inflation expectations are a big component. We don't know that for sure that this will be a one-time pass through. So I think it does make sense for the Fed to wait and see. And maybe they cut twice by the end of the year. Maybe they only cut once, slightly below what the market is expecting right now, in order to wait and see, make sure we're on stable footing from that standpoint.
Mary, on this point of these tariffs getting passed on to the consumer, I purposely won't use the company name, but they raise prices pretty considerably based on, oh, we're going to have to pay these tariffs. And the consumer really objected. Their sales literally dropped through the floor. And so did the price of the stock, by the way. So that's why I'm not mentioning it particularly. But we're seeing stuff like that happening where the consumer finally is going, I'm done. I'm not paying these higher prices. And I'll bring up one example also in the real estate market and renovations and costs. People are just going done, done, done. When did the consumer crack or just go enough? I'm not paying these prices.
Well, I think it's also a value conscious consumer as opposed to a consumer that completely falls apart. And you do see that with different companies where perhaps people are not necessarily looking to buy the highest end luxury items. They're also not looking to price take in some of the discount stores, but they're trying to find what do they really need to buy, where can they pull back on items, and where can they preserve their spending. So I do think it will become a bit more of a judicious consumer overall in terms of what they want to buy. Doesn't mean they have to, again, roll over and not be able to spend. So I think that there is a bit of a balance here. But certainly underneath the surface, we're seeing different trends among different income and wealth groups, where you see a bit more of a slowdown in spending from some of the lower income cohorts relative to the upper income cohorts. But I do think certainly the consumer's probably at the point where it's not buy everything that it was a couple of years ago, and they're a little bit pickier about what they're doing going forward. And that's going to affect a variety of different consumer companies in different ways.
Mary, in addition to the consumer, I think this is also one of the first times that small business owners are also the linchpin to the economy as it relates to, the tariff headaches that they've been going through. So I know JP Morgan is phenomenal in doing various research. What are you seeing from small business owners, A, in relation to their confidence, and B, their reluctance to build up their inventories, as Dom and I mentioned on the open?
So I think that coming into the year thinking about tariffs was very much, well, these large multinationals that have a significant amount of foreign revenue will get hurt, while some of the smaller cap companies are more domestically oriented, so they'll be more insulated. But the reality is, if you're a large company, even if you do have a lot of domestic revenues, while that may, or excuse me, foreign revenues, while that may be a headwind from a demand perspective, both foreign and domestic, on the flip side, you have the scale to absorb some of these higher costs, and some of them you might pass through, some of them you may not. You probably also have the margins to be able to withstand some of the pressure here. On the smaller business side, that's a lot more challenging because you've already dealt with years of inflation, and therefore, even if inflation is not higher or accelerating at an overly worrisome rate, you still have the higher price levels, both in terms of your inputs and what you need to think about charging your consumer and how sensitive they will be to that. So I would certainly say that some of these areas are headwinds, especially if you don't have the wherewithal to absorb that as much. So I think we see that, and I think that translates to how much companies can spend when we think about CapEx, when we think about hiring. We do look at the NFIB's small business survey, and you have seen some of the sentiment there has turned a bit sour, all the way from the small business level to the CEO confidence level. So certainly that is a factor there.
And Mary, just to follow up to that, sorry, Dom. I think it's not just a wherewithal. I think it's also a frustration. I was talking to a client last week who owns a second generation plumbing supply company. And he said to me, normally it's summertime, I build up my inventory for the heating season in the winter. He goes, I'm not this year. Because if they're going to change the price every other week, why would I make purchases if I don't know what if it could be cheaper 2 or 3 weeks from now? So, in addition to not having the ability to, this man has the ability. He just doesn't want to spend the money because he's just tired of the turmoil, and he's a supporter of this administration, right? But he's got a. So, are you seeing that as well? It's not just the ability, but also the frustration not to want to.
Sure. I mean, when you look at the first quarter, you had a big positive swing from an inventory perspective when we look at GDP. So I think there was a lot of front loading going on early on, but now it's sort of the opposite, where it's a little bit wait and see. Let's spend down the inventories we have. Let's see where we go from here. It's really hard to make some of these decisions, and that's why I think, particularly when we think about larger capital spending, a lot of that is getting punted down the road, even if a company has the wherewithal to do it, because what if things, forget about whether things will change in 4 years, which is important for some of these big capital decisions, but they could change in 4 weeks. So you do see that companies instead are investing in different ways. I mentioned buybacks earlier as one of them, but that's not really relevant for a smaller company or a smaller business. So they have their hands tied a bit.
So, Mira, I'll throw out the question. We'll see how much time we have for you to answer it. But you've mentioned margins, earnings, valuation. You got an S&P right now. Maybe consensus is around $260 plus or minus. That's already 23 times earnings, right? I'm trading on a 23 times multiple. And yet we talked about a consumer that might be a little bit tighter with their money. Small businesses, again, a little bit. How solid do you think these earnings are going to be the second half of the year? And aren't we already trading at a pretty high multiple?
We are trading at a pretty high multiple in multiple lenses. So if you look at the Mag 7, if you look at the top 10 stocks overall in the S&P 500, if you look at everything else outside of some of those large companies, valuations are still, nearly 20% higher than their longer term averages. Now, some people make the case that those valuations are warranted. You have more growthy companies. They've been good at producing profits. They've been able to withstand higher rates, but nonetheless, they're pretty high. So that is something we want to be mindful of. And mechanically, if earnings come down, then valuations actually re-rate higher. So we do need to be mindful of potential re-rating around valuations. And from an earnings perspective, I think we can still see positive earnings growth, but rather than mid to high single digits, it'd probably be low to mid single digits. So something to be mindful of as we hear more and more from companies throughout the year, that we're probably going to get more of these downward revisions, both from companies in terms of the way they guide and analysts in terms of the way they think some of these earnings will actually play out.
Mary, this is a good time right there to take a quick break. So hold your thoughts right there, and we will be back with after a quick break with Mara Pandit, Executive Director and Global Market Strategist at JP Morgan Asset Management. All right, I'm Michael Hartzman, back with Dominic Tavella and our guest this evening, Mara Pendant, Executive Director and Global Market Strategist at JP Morgan Asset Management. So, Mara, I'm sure you know this, Dom, you may know this, but I learned last week that the reason the media calls the new tax bill working its way through Congress the big, beautiful bill is because that's the actual name of the bill. It's actually called the Big Beautiful Bill, which I didn't know until last week. I was at a meeting in the city. We had a Washington update, and that's what it's called. The official name of this tax bill. Did you know that, Dom?
No, but why am I not even surprised?
Mira, I'm sure you knew that. Did you know that
You,
it's actually what it's actually called?
When you look up the and the government websites to take a look at the text of the bill, that's the name.
Yep. All right. So that being said, what do you think about the big, beautiful bill working its way through Congress right now?
It is right now working its way through the Senate. So it passed narrowly in the House, and they're hoping to get it to the president's desk by July 4th. We might see some slippage there, but it's got a lot in it. So, in terms of taxes, there is the extension of the Tax Cuts and Jobs Act. There's also the revival of a number of different business provisions from the Tax Cuts and Jobs Act that essentially faded out over the last couple of years. No explicit lowering of the corporate tax rate, though. And then some new items, things like no taxes on tips and overtime. And that's really the big headline there because a lot of the rest of it was extending what we already had. This is potentially new taxation, lower taxation for consumers. So that could actually result in a little bit of a sugar high, a bit of stimulus coming into 2026 when this is enacted, if that goes through in the current form. And my understanding is a lot of the sticking points right now around some of the spending cuts and wanting to see perhaps some more or in some different areas, as certain benefits programs like Medicaid have pretty substantial cuts. So let's see what actually makes its way through. But it is looking like on net, this is probably going to be a deficit expander over the course of the next decade. What's also been interesting is that some of those spending cuts don't necessarily kick in till later, and yet some of the tax items are set to expire around 2028 or 2029. And in all likelihood, similar to the Tax Cuts and Jobs Act, you see those tax cuts extended once they're in. It's really hard to take away a tax cut once it's there. So it's not necessarily reflecting probably what the eventual cost of the bill will be. So I'd say from an economic standpoint, one, probably going to increase the deficit. So we have to be a little bit cautious around thinking through the yield impact when we consider the markets. Two, potentially we see a little bit of a uptick to growth in 2026, but then likely to fade out. And three, maybe that has somewhat of an inflation implication as well. So all things to be mindful of as we see this taking shape.
um, just switching gears a little bit. For a decade, both myself and Michael have been going to great meetings with some of the smartest people in the room. And you have to buy international, you have to buy emerging markets, you have to put that in your client portfolios. And for a decade, I don't know how accurate that was, but all of a sudden we wake up and international and emerging markets are doing phenomenal. Give us the why and why should we buy into it?
Valuations have been low for years, so it's not necessarily, oh, they're cheap, because that's been the case for a long time. What we have seen turn around this year is one, when you're a US investor in international stocks, typically you not only benefit from the asset return, but also the currency return. And we have seen that the dollar has come down pretty substantially. So that has been a help across many regions. But then you also have very specific stories across different countries. So take Japan, for example, a lot of corporate reforms. They want to be a little bit more shareholder friendly, and those reforms have been underway for the last couple of years and are bearing some fruit. Then take Europe. You have not only seen that they have cut rates pretty substantially over the last year, and they tend to be a more interest rate sensitive economy, so that helps them a bit more. but they're also planning on doing more fiscal spending around infrastructure, around defense. So that could potentially help earnings and growth overall. I mean, look at very specific industries within Europe. The cyclical areas of the market are actually doing the best when it's been all about tech in the US for the last couple of years. You think about other areas outside of the developed markets, areas like China benefiting from AI and some stimulus within their economy. Areas like India, some of that earnings growth has come down, but it's still at really high levels and has some really favorable structural aspects to it. So I think this international trade does have legs. But I will be mindful of the fact that it's been tough going for a number of years. I'm not saying let's completely switch our allocations to be massively overweight international, but let's bridge some of that underweight because I think going forward things will start to be a little bit more competitive internationally, and therefore we can benefit from having different levers to pull on within our portfolio, particularly when the US market is very concentrated and not particularly cheap.
Mira, if I can, I just want to go back to the tax bill
Sure.
about no tip on taxes. I'm sorry, Dom.
No, please.
At the risk of being skeptical, millennials and Gen Z never walk around with any money in their pocket, right? So it's easy to capture their tips when they put it on a credit card. But Dom and I, baby boomers and Gen Xers, still walk around with money in their pocket and will frequently pay a tip with cash. So again, you guys do research on everything. So do you actually have any data on what percentage of tips actually go reported and what the benefit of no tips on taxes will actually be to these people?
I think that's a good point. That's definitely something we should take a look into in terms of, what how this will actually play out. And I think that the broader point here is we have a huge question mark around the implementation of this and how this plays out when you think about both tips and overtime. Does this change how people's compensation structures work in general because they want to take advantage of this? So it is a big outstanding question mark in terms of the implementation in a practical sense of how this plays out.
And the net economic benefit, do you think there's any significant benefit to this?
You probably will see a bit of a pop in consumption if people are feeling like they're all of a sudden a little bit richer than they were before. But then things adjust to that higher level. So you again might have a little bit of a sugar high in the first half of 2026, but probably slower growth thereafter. And then we do have to think about the longer impacts of debt and deficits. And while we never think the US is going to default on their debt, certainly over time, having a weaker position from a federal financing perspective does weigh on growth, does push up inflation. So there are some longer term impacts here that are on the table.
And the flip side of that, Mira, is restaurant owners, people who are in the service business, they do pay their employees a nominal wage, right? They don't live entirely off of tips. So do you see, just counterintuitively, business owners now, restaurant owners going to their employees' hotels saying, look, we were giving you whatever it was, $15 an hour. We don't feel we need to pay that much now because your income is tax free from the tips. So, do you see it as a potential boost for business owners as well in certain sectors?
It could be. I mean, again, it could really change the way some of these, some of the way compensation is structured and some of the way businesses operate, how we think about wages and wage growth and some of these compensation structures. So, I don't have a good answer to that yet because we don't exactly know how to be implemented and how it'll play out. But certainly, there's a lot of unknowns around the impacts here.
Mira, just again changing a little bit here. We've talked quite a bit about tariffs and the effect on the U.S. consumer and U.S. businesses, but how about what it might do to, for example, Germany and the total number of cars they export, or South Korea or Japan, the total number of cars they export and into this country? That is a significant part of those three countries' economies. Is there global implications, global growth implications to these tariffs?
Sure. The implications are pretty far flung because it's not just, from an autos perspective, it's also, even with US automakers, how many times they're crossing the border back and forth to Canada and Mexico, for example, and auto parts, for example, as well, in order to get that final product, even if it is an American made car. So whether it's domestic or whether it's foreign, certainly these auto tariffs are going to have a pretty big impact. And I do question, how much of that may come down mutually, because while we might see some degree of higher auto tariffs, it may not be as high as it is expected to be today. So that's definitely something to consider when we think about some of the impacts abroad. What we also have to be mindful of is I think we did come into this year thinking the US has an incredibly strong bargaining position here because trade is not that big a part of our economy. But even in a place like Europe, where exports are about 38% of their GDP, how much is actually going to the US is like single digits. Whereas a large share of the exports from Canada and Mexico are going to the US. So there's a little bit of a different position there. But many countries, while they are very trade oriented, are not necessarily solely trading with the US. So they do have somewhat of a diversified export base as well to think about. But nonetheless, and look, people wouldn't be coming to the bargaining table if this wasn't something that was going to be hurtful to their overall economy and businesses.
Mira, let's spend the last 10 minutes or so talking about asset allocation for the rest of the year if we can. Um, Using, your cheat sheet, which I use every week, not just because you're on. Year to date, consumer discretion is the worst performing sector by a wide margin, which makes sense, right? If people are going to tighten the belt, they're gonna spend less on discretionary income. You and Dom talked about international investing. So if you were going to take out your crystal ball for the second half of the year, what would you advise our clients and listeners in terms of, asset allocation, what to potentially, might be a minefield? What do you think might be a little bit more, quiet for the second half of the year?
Balance is going to be important when we think about value versus growth. For example, the AI trade is alive and well, and certainly there will be a number of different beneficiaries there, not just in tech, but also when we think about the broader AI infrastructure, and then who's actually using these AI tools, the number of different sectors and businesses and industries that then become AI adopters. So I would certainly say tech is a piece of that. It's not the only piece, but certainly we've seen that some of the growthier areas of tech are coming back. On the value side, it's been very interesting to see the breadth of performance within some of the value areas of the market. It's not only some of the very defensive areas when it got very volatile, like staples or utilities, but it's also areas like industrials, financials that have done well, potentially benefiting longer term from some of the policy changes. So I would say a diversified stance within the value style has certainly helped. What we've also seen is that when volatility has picked up the most this year, the spread between value and growth was the widest, with value outperforming. So it can be somewhat defensive in nature, and not, again, just in some of the defensive sectors themselves, but also across the board. When we think about this from a policy lens, look, areas like financials are more service oriented. Areas like utilities are more domestically oriented. So thinking about areas within the market that can be insulated from some of the tariff narrative and perhaps benefit from some of the broader policy changes. I think about financials as the main beneficiary from a deregulation standpoint. So still some opportunities there in the US. And internationally, I would say our preference right now is for developed markets over emerging markets. And certainly within Europe and Japan, we see some runway to both of those areas. So when we think about nipping away at that international underweight, consider some of those areas within the developed markets. And then on the fixed income side, it feels like you take a look at yields, and the path of least resistance here is yields moving higher. There's certainly risks to yields overall. And yet, when you look at all the different returns across different sectors within the fixed income market, different maturities of treasuries, most areas of the bond market have been positive year to date, which I think is pretty surprising given the fact that we just continue to see yields tick higher. So broad and diversified fixed income has definitely been your friend. And I would say if you're not as interested in taking risk within the equity market, some of the areas of the credit market look attractive, whether it's investment grade or high yield. I'm not saying it's necessarily cheap given where spreads are, and yet you're getting pretty good income. And that income can serve as not only income, but also cushion. And if we're not necessarily headed for recession, some of those areas are a nice way to participate in company balance sheets and company profitability without perhaps taking on as much risk in the equity markets, but also not necessarily seeing spreads blow out as they would in a recession. So a couple of different spots. Maybe the way I'd summarize it is all the areas of the portfolio that you've hated over the last couple of years, whether it's value or international or bonds, have been what has helped to grow portfolios this year.
On the same theme, both small caps and mid caps have had a really, really rough year. And that was one of the targeted areas that you just had to own in January, and probably two of the worst areas. But I would say the last week to 2 weeks, they've made some pretty strong strides to getting at least back to break even for the year. So again, any thoughts from your team, yourself? Own it, don't own it?
This comes back to the comments earlier about tariffs, where it was assumed that large cap would get hit the worst because of their foreign revenue, and that some of these domestically oriented companies would be more insulated. But the overall environment is challenging, and certainly small and mid cap companies are not immune to that. Ultimately, small cap companies do well when growth is accelerating, and we do not think growth is going to accelerate this year. So it could still be somewhat of a challenge. I'd also say when we think about the interest rate environment, there's a lot more floating rate debt held by small cap companies than large cap. So in a high for longer environment, that creates somewhat of a strain when we think about debt service. And then when we look at some of the profitability dynamics, especially over the last couple of years, you have had sky high expectations for profits, and you haven't necessarily seen them materialize. So in small cap, you had double digit positive expectations, something like 11 or 12, 13% in 2023, and profits came in negative 12 or 13%. In 2024, you had positive 24% growth expected, and you had negative something like 17% profit growth. So you had a couple of bad years there. You didn't see the same thing in mid cap necessarily. You saw profits come in a little bit lower than expectations, but not by so much. So perhaps that's still a little bit of your sweet spot. And certainly there's areas when you're selective that are attractive within small caps, but selectivity is key to avoid some of these minefields within the small cap space.
So just switching gears a little bit to again your top 11 sectors. People frequently equate energy and utilities kind of as completely correlated and side by side, but what's the disconnect with energy being down 1.8 and utilities being up 8? Is it the dividend? I mean, what's happening there?
From an energy perspective, let's think about this very simply, and what are oil prices doing?
Hmm.
And right now, it's always very much a story of supply and demand. From a demand side, if we do see the economy slow and there's less activity, you perhaps need less energy. So the demand story might be a bit weaker. And on the supply side, it does look like OPEC Plus is committed to continuing to increase production, with the number of executive orders aimed at boosting production in the US. Certainly, the administration is trying to pave the way for more production. And yet, if you are an energy company and you produce more supply, then if oil prices come down, you're going to be less profitable. So I think there are some challenges around profitability when we think about prices at this level. On the utilities side, utilities have actually benefited greatly from some of the big secular trends. Again, think about things like AI and wanting to power data centers. That's where utilities come in. Utilities are, again, very domestically oriented, insulated from some of the tariff challenges that we're seeing. They are fairly, particularly they're publicly regulated ones, also fairly insulated from higher inflation because they have an allowable return on equity, and they are able to adjust in concert with inflation. Not that that's necessarily been a problem this year, but that provides, again, a little bit of buffer if we do see inflation take off. So that there are certainly a number of factors from a utilities standpoint when we think about broader energy transition, power demand, whether it's AI or just general power demand, when we think about computing, that makes a sliver of utilities sort of somewhat more growth oriented.
Dom, I got
Mira,
2 minutes. You get the last
yeah,
word.
I can sneak one in. Bear with me. So I would think the politics coming out of Washington really hurt the healthcare industry and healthcare stocks this year. And I kind of remember back to the Obama era and Obamacare that the actual reality ended up being a lot less negative than people originally thought. So you're looking at the sector down negative plus 2% for the year. Is there some light at the end of the tunnel here? I mean, these are usually good, high quality, good earnings, good growth stocks. They've gotten hurt pretty bad this year.
They have, and I think the political overhang, it seems like in any administration is always pretty challenging. And also when so much healthcare spending from the government is always in the spotlight and always getting quite a bit of scrutiny. So I think that that's going to continue to probably be some degree of overhang. You may see a situation where if there is more M&A and more corporate activity, a lot of these companies, particularly on the pharma side, really depend on being able to acquire other producers and continue that drug pipeline if you're thinking about that subsector in particular. So perhaps that could help here a little bit. I would say that there's just other areas of the market that feel like they have a little bit more certainty and a little bit less of the clouds than healthcare right now.
Mira, unfortunately, unfortunately for us, we have to stop here. We're out of time. So again, Dom and I just want to thank you for making the time this evening and shedding some light and some logic on what's been a pretty crazy couple of months.
Absolutely. Thank you again so much for having me.
Much appreciate the common sense and the clarity, and looking forward to hopefully doing this again with you. Thank you.
Absolutely.
So Dom and I are off next week, but we'll be back in a couple of weeks with a new edition of the Lebenthal Report.